All right, good morning, traders, and welcome to the opening bell. Today is Friday, August 7th, and I'm Michael Boutros, Senior Technical Strategist with FOREX.com. Pleasure to wrap up the week with you and start the session with you this morning. We just got the release of U.S. non-farm payrolls coming in much weaker than anticipated, with a negative 23,000 print, missing an 80,000 expectation. The consensus was somewhere in that zone. Unemployment down ticking, but we saw that contraction in labor force participation. I often tell you guys that'll oftentimes put artificial downward pressure on the unemployment rate. We'll look at all the US dollar crosses. I see your questions on Aussie and CAD. We'll go over all of them. We got CAD employment as well today, and gold and oil. Any other questions or trade setups, feel free to throw them on the message board. All right, great to see everyone in the room this morning. Angie, Ashish, Chandra, Don, good morning to you. Latanya, Acacia, Yana, Chandra, great to see everyone this morning. Here's what it looks like on the DXY. We're right at support, 99.41, 99.49, the objective monthly and weekly range low, the 38.2, the advance off the yearly low, and the January high. It's all right here. We're testing that support pivot right now. Here's what it looks like on the 4-hour chart. That formation we've been tracking off the high remains in play. We were talking about a bearish bias below 100 spot 35 with bearish invalidation at 100 spot 77. Key support is 99.41, again into 49. We're there right now. The downslope converges here. A break, a close below this zone opens up the potential for another major leg lower in the DXY. The next level down would be that 200-day moving average right above 99, basically 99.18. And then the May low and August high day close gets you 98.69, 98.70. So we are testing a major pivot in price. And it's not just on the Euro DXY. It's also on a lot of the other majors. But before we jump in deeper, here's what the print looked like. Negative 23,000. We were looking for a print of 80,000. Now you saw, what's his name? The economic counselor for the president was just on the headlines, and he was saying, there's a lot of different things in play here. Obviously, there's some talk that there may be just a sort of deteriorating or scale off effect from the World Cup. That might be what's in play. But there's a couple of interesting concerning factors. The labor force participation downticking. This has been a phenomenon we've been watching. There's a couple of different, again, factors you can point to, whether it's the tighter immigration policy, whether it's baby boomers continuing to retire. The labor force contraction makes it so that your break even on the unemployment rate is somewhere in the range of 40,000, he noted. So yes, there is maybe some underlying weakness in the labor force, but we're seeing that dynamic change with the participation rate contract. And this will always put artificial pressure on the unemployment rate. It's just it's statistical phenomena. As you contract the labor force, the unemployment rate, the number of people employed to the number of people unemployed will start to look better. So an interesting print certainly suggests there may be some softening continuing going on in the labor markets. And this now puts the focus on next week's CPI release on Wednesday. We're expecting CPI and the inflationary picture to dwindle a little bit, soften from 3.5 to 3.4 on the headline, with core expected to drop from 2.6 to 2.5. So what does this all mean for the Fed? Well, the expectations have continued. So let me reset this again, get the freshest view here. But we rose to 60%, softened just a little bit just now, but I put this out on X just a few minutes ago. We were looking at this all week, guys. This was at 38, 36% yesterday. Now markets are starting to price in a higher likelihood that the Fed will hold next month. The October read also getting a little bit of a kick. Even in October, you're barely above 50, 58% that will see them at least with a 25 basis point hike. So this print has basically just given the Fed more latitude, right? To be able to stick around a little bit longer before having to move, with the concern that now the inflation market's weakening. So do we really have that much justification to raise rates? I've been saying this for a while, guys. We still had up till yesterday some bank research, and even Kashkari, who was on, Neil Kashkari, Fed member, who was saying 3 hikes this year isn't outside the realm of possibility. I think now we could say it potentially is, unless the inflationary picture really starts to accelerate and deteriorate, I don't know that we'll necessarily see the Fed with enough justification to move on rates here. So we'll see what it means. For the dollar, you're right at a pivotal support, okay? We would need to close below 99.41 to validate a break of the weekly range and really keep this thing going, looking for that 200-day. Slope comes in just a bit lower, right around 99, by the way. But all things held constant, you're just checking the support structure right now. Euro dollar looks like this. At resistance, 1577, 1576 into 15, what was it? Got to get the right number, 78. Okay. It's exactly where we just topped out. Now, this is where things get dicey. Okay. Because technically, this is a breakout of the objective weekly opening range. Nothing supersedes basic support and resistance. Just a quick side note, I did get a comment on one of the YouTube videos, I think it was yesterday, from Cody asking about a little bit more information on the weekly opening range and just the basic opening range strategy. I would encourage you to read a book called The Logical Trader by Mark Fisher. Really kind of outlines the basis of the theory. But one thing I just wanted to highlight is the opening range, guys, is not a strategy in and of itself. It is a tool, just as momentum, just as any other oscillator you use. It is a tool to help us validate trend. The entries and the exits aren't going to be dictated by the opening range. That's to validate it. So ideally, you're in it as the opening range breaks. Or if you're waiting for the opening range break, it's got to be a kickback test of support. So you have a stop to trade against. So I could do a whole webinar on that, but just a quick side note to answer your question there, Cody. So euro dollar, 1576, 1578, that's resistance. We're checking it right now. A breach above this level is what would need it to keep this immediate upside bias in play. You'd be looking for 1609. And remember what I told you on euro. My concern is that it's really stacked up if we break beyond this zone. 1609 is the 1618 off the low. The 200-day moving average is 1627. And then a key 618 from the April decline is 1650. So it's really loaded up beyond that. So keep an eye on those levels. You need a confirmed close northbound of this zone to keep the immediate upside bias in play. Here's euro on the weekly charts just to highlight, again, that January low at 1578. Really nice pivot in price, specifically on the weekly charts. Very, very nice. The next major level up from the weekly standpoint is going to be that 618 off the April high. It converges on the 52-week moving average, the objective yearly moving average at 1639, and the 618 slope of this pitchfork we've been tracking off the high. So this is still going to be critical, and that's going to be the next major resistance zone if we breach above this level right here. Right now, watch today's close with respect to 1576, 1578. Initial support, if we are heading higher on this stretch, I would want to see losses limited by the objective weekly open. That's 1535. You need to break above 1578 to mark resumption. Questions, comments, concerns. Note that momentum is trading right at 70 on the 4-hour chart. Topside breach above resistance and a momentum pull above 70 would certainly be further conviction on a resumption higher. All things held constant. DXY is checking big support. Euro checking big resistance. Any questions? Hey, Mesfin, I got you on dollar Swiss. Yep, let me just get through this. Here's sterling. So the major pivot at 34.74, 34.60. We've been talking about it for months. I don't want to go over all the levels again, but it's a huge cluster. Fibonacci considerations, the February low day close, the objective yearly open. We've been straddling that ever since the start of the month. This is an objective test of what? The objective weekly open, the weekly opening range high, the monthly opening range high, and uptrend resistance. So sterling, yet another pair testing objective resistance at the weekly range high. That's the break you need to validate resumption of the uptrend. Another trade, which is trading right below overbought. See that break into overbought. See a push through 35.09. Next level up is 35.92, 93. That's going to be the 618 off the high and the May, August highs from last year. So a very nice level on the upside if this were to break. Sterling is checking support right now. If we're heading higher on this stretch, okay, look, this is really near term, okay, but the weekly open here comes in at 34.87. I wouldn't want to see anything below 34.60. Remember, we started off the week saying bullish invalidation at that basic 38.2 retracement of the lows. The 200-day moving average is there. That's still the level that would put the bears back in control. But right here on this stretch, if we're going to test higher, look 34.86 initial support. If we settle back below 34.60, that would be another exhaustive move and a failure to break that pivot. So levels are really well defined here on sterling. Okay, still starting to come out of that. It's been on the watch list all week. I've been telling you this, and dollar CAD, obviously, which is finally making a move here today. We're kind of my least favorite setups, but if we get some clearance here, we start to shift this back into focus. So watch today's resolution above 35.09 for continuation. Need to hold 34.60 for heading higher. Here's Aussie. Acacia says, good morning. NFP was insane. I had another long Aussie that was pushed to its take profit. While I had a much smaller trade on dollar Swiss, I was using the hedge against Aussie. My Aussie trade stop was wide enough to survive. Okay. Well done, Acacia. Here's Aussie right now. Next level up. Man, this thing actually ended up being pretty clean. Remember, since the start of the month, we popped back above, and we closed last month, to be fair, above that 70-70-22 level, which is the level we were talking about all throughout July. We dipped right into the open of the week, but then we popped through. Yesterday, we stopped at support right there, 70-22, top end of that key pivot zone. And we were talking about resistance at 70-82. We just missed it. We still could get the tag, but that's the next major pivot zone. Momentum, another trigger waiting here with momentum just below 70, resistance overhead at 70-82, 70-83. Big zone, guys. This is the 618 extension, the initial advance off that June low. It's the broader 100% extension of the 100% extension of the advance off the broader structure here, just that low, high, low. Both of those converge on uptrend resistance over the next day or so. Look for a break here. Subsequent resistance beyond 70-83 takes you into that key zone at the 618 retracement of decline off the high. That's 71.20. That converges on the upslope basically Monday, Tuesday of next week. Okay. Again here, weekly open support. Raise that up to right there. It's basically 70.36. That's going to be initial support now for heading higher on the stretch. Any pullbacks need to be limited to this zone. You need to close above 70.83 to validate the next leg up towards 71.20. Aussie making a break here. Now, I just want to take a step back. On an example like Aussie dollar, there was no definitive clear-cut break of the weekly opening range. Here's your weekly open. You set a high, you set a low, you stretch that high a little bit higher, never went for a test of the low. So you don't have a conviction like weekly opening range break here. That said, we're still working under the assumptive move that we've broken above that May downtrend. This is your first test of former slope support turned resistance. Here's what it looks like on the weekly chart to put things in perspective. Okay, so this is why we want to be a little bit more cautious here. If we pivot back above this slope, former slope support off that November low, right? That opens up that 71.20 level. It's also the February high close at 71.16. So the levels are really clear. Aussie at resistance, Euro at resistance, Sterling at resistance, DXY at support. Here's dollar CAD. Acacia, does that make sense? Give you some clarity on that? Weekly open support needs to hold if we're heading higher on this specific stretch. Key support still 70 into 70.22. Initial resistance 70.83. Next level up 71.20. All right. That's Aussie. Here's dollar CAD. So we also got the release of CAD employment data. Here's what it looked like. The CAD employment data was right here. Came in at 75,000, well above expectation. We were looking for a print of 15,000. The unemployment rate drops from 6.5 to 6.4. Okay, and so you're seeing pretty much a pretty strong reaction. The dollar losses compounded with the CAD sort of move is putting dollar CAD right into support. You remember earlier this week, this was one of the trades I was least favoring because we said, hey, this rejection of the median line would have us look for a test of the lower parallel. And so the 25% parallel held for 4 days. We buckled below it here on Wednesday. And yesterday, the rally failed right at that 25% parallel again. And so we finally are getting now a test of the first major lateral level of support. Here's dollar CAD on the weekly chart, 39.56, basic 38.2 of the entire yearly range. The March 2022, the March and 2022 swing highs are right there as well. So there's a pivot on the weekly chart. Watch that zone. Here's what it looks like on the daily chart. The September high day close and the October low day close from last year come in right there. We're testing the bottom end of that right now at 39.42. Short exposure beyond here, you want to be a little cautious, okay? Because we have the upslope for the broader yearly uptrend converging on channel support. That now comes in right around here. There's not a lateral level to highlight. There's no convergence zone, but I'm looking at just above 39. So that's the threat. If we buckle below here, may see a larger reaction in price. This is just a slope, parallel, extending off the lows, converges on uptrend support. In time, that's basically telling you into Tuesday, Wednesday of next week. Look for a reaction there if reached. Right now, you are testing a key pivot, so dollar CAD at support as well. Here's the slope. So one of the only dollar crosses that's actually already broken to oversold conditions. So the momentum profile is in favor of the bears immediately as we speak. If we were to pop through 30 again and we hold this support, that would be an exhaustive pump. Clean weekly opening range has us looking for a late week low. It's Friday. Okay. So I'm still, just for the record, I'm still not thrilled with this slope. I've been trying to figure it every which way to see if I can find a better slope that kind of fits with price action. You can kind of toggle with these highs that we made in early June, or I guess that's, yeah, the early July trade. But I'm working just with the key lateral levels here in the daily chart is kind of my key. So watch for an inflection here. You need to close below 39, basically 39 proper, to invalidate the yearly uptrend off the January low. That would be a fundamental shift in the technical picture. So if you're holding short exposure specifically on CAD, maybe a good region to reduce position size, lower protective stops to break even or better. Next major threshold, if you break 39.40, excuse me, watch that 39 level. Okay. Questions on dollar CAD? Clean break of the weekly range. Okay, dollar yen. So man, there's so much commentary on this. It's hilarious over the last few days, especially with the pop yesterday above 57.90, clearing the 200-day moving average. Man, that was so short-lived. Everyone's got to kind of take a step back. I've been getting a lot of questions on this. You know, is this going to be the same result that you saw back in the last intervention? You see a massive move, markets come right back in, carry trade right steady as she goes. The only thing I want to bring to your attention, and I don't want to take the time to go through it here, guys, but if you go back in the charts and look at the 1998 example of the last coordinated intervention, you did see the market challenge in the following days after the initial move for a decent like 5% rally off the low. The deeper cut of the broader move in dollar yen to the downside took months. Okay. So it's going to be difficult, in my humble opinion, to see traders step right in here and we get back up above 160. It's just, you know, the likelihood is in my humble opinion, again, based on historical price action, is not going to necessarily be a move like that. I liken this to the move that we saw in gold. You know, when gold initially broke and you saw this rally, everyone and their mother was about, okay, here's 6,000. I want to get back in. The washout is done. No. You know, after a clear out like that, after a move of that magnitude, it takes the market time to digest that. And so with the dollar yen, similar scenario. I think you see a lot of volatility over the next couple of weeks, but do we get straight resumption? Look, the line in the sand is 60.73, 60.36. Nothing changes. If we were to topside breach above that level, which was the origin of the breakout zone back in June, that would nullify the pullback and the technical damage that was done into the close of July. Until that happens, expect some volatility here. But I do think that the risk is still going to be for a deeper cut in the weeks ahead. Here's the weekly chart. Reminder that that uptrend did break and close below last week. So this week's rally faltered right at former channel support, turned resistance. If we close below 58 proper, 57.80, I think that, you know, you're still at risk. Now, the pivot point on the chart is still going to be the objective yearly open. We just tagged it again. It's the 618 off the low. It's the objective yearly open, not Mike Boutros' opinion or FOREX.com's opinion. Fact, that gives you 56.63 into 56.66. We need to close below that to keep the bears in control on this immediate stretch. All right. Approach any dollar yen exposure nimbly. Reduce position size. It's not a trade, in my humble opinion, where any type of technical conviction is going to warrant the risk that you're facing with, a coordinated central bank intervention. So keep that in mind. Questions on dollar yen? All right, Mesfin, this one's for you, brother. Here's Swissy. So we attempted to break the weekly opening range, and I put this out on X as it was happening. The break of the weekly opening range high was right here. The key topside region of that was 81.24, but we did not close above. So it was essentially a false breakout. Okay, it was happening right in towards the latter part of the session yesterday. We were breaking above the objective weekly range high, resistance held. And this is why, guys, we always take a step back and we require the daily close to convict the break, or to give us conviction that the break is legit, A. And B, this is why for Cody, just another note, as you were asking about the opening range, we don't want to, opening range is not a strategy in itself. Remember, nothing supersedes basic support and resistance. So while the weekly opening range was breaking, we were looking for the daily close above 81.24 to validate the breakout. We did not get it. Look at this. You can't make this stuff up. We closed right there, and here's the subsequent reversal. We're right back at support. So what does that mean for dollar Swiss? Nothing changes, Mesfin. Nothing changes. You're testing near-term uptrend support. This is the same formation we've been tracking since June. Resistance at the upper parallel, resistance at the 75% parallel, break the median line, test of uptrend support. The weekly opening range low is 80.56. The January high is 80.41. Uptrend support is there. On the daily chart, the median line for the yearly uptrend is there. Dollar Swiss is trading into support right here, right now. Confirmed close, a daily close below 80.41 would validate a break of that uptrend from late May, right? And would validate a break of the objective weekly opening range, as well as a break below the median line. So 80.41 would open up the potential for the April high day close. That's 80. The key support for the broader yearly uptrend is at the yearly open. That converges on the 200-day moving average. You're talking about 79.31, 79.27. So we're not out of the woods yet. Dollar Swiss, just like all the dollar majors, guys, are now testing key pivots right into the US Open on the back of that non-farm payroll print. We need to see a close break below 80.41. Otherwise, you're still sitting in a range right above uptrend support. Make sense? Okay, nothing's broken yet. We'll continue to track this right into the close of the session. Makes a lot of sense. Thank you, Michael. More than welcome, Mesfin. That's everything on the FX front. Just a quick note, we were talking about Aussie CAD yesterday. We're still right in the middle of that range. You're sitting right at the objective monthly open right here. So nice little pivot right slap in the middle of that range. So that's something you want to continue to track over the next few weeks and days. Quick reminder into the room, I'm off next week. So my good friend and colleague, I worked really hard to get him for you. James Stanley will be covering most of the week. I think Razan's going to pop in on Thursday, but just keep that in mind on the Aussie CAD setup. All right, gold, woo-wee, continues like a charm. So the pivot zone that we were looking for yesterday, 43.05 into 43.19, the objective yearly open, the objective 38.2 retracement of the April decline. We tagged it yesterday as resistance. We pulled back. We said, hey, if the pullback is legit, we should hold the median line. It's an exact hold at the median line. Here's a breakthrough, the 75% parallel and that yearly open. We've already hit the target ahead of schedule at the May low at 43.66. Now, initial support right back at former resistance, right back at the 38.2, right back at that 2026 yearly open, 43.04 to 43.19. If we pivot, close northbound of 43.66, you're looking for the upper parallel. Right now it comes in near 44 proper. Next major lateral zone is very clear and well-defined here on the daily chart, right here at the 200-day moving average and the 618 of that April decline. That gives you 44.93 into 45.33. The broader yearly downtrend is right there. That's the breakout that suggests, hey, a much more significant low was registered in June and a larger trend reversal is certainly underway. Okay, that's the level. Right now, this is a breakout for sure. Remember, last month's opening range never broke. So we talked about this on Wednesday as a confirmed breakout, no doubt about it. But for the broader yearly downtrend, that's sort of a major level. Now, if we look at the weekly chart, I just want to show you this level. This is the same slope that you're looking at on the daily chart. All I have here is the 50 line. If we bring up the exterior levels, there's that key level that I just showed you on the daily chart right here. That's the 38.2 of the yearly of the decline off the March highs, not the April highs that we're looking at on the daily chart. The actual March high, 38.2 is 45.06. The 2025 high close on a weekly standpoint is 45.33. The March low week close right here, the week the low is registered in March, the close was also right here. All of that converges on downslope resistance in the next few weeks. Okay, so this is your first major pivot. Watch today's close with regards to 43.19. This is your next major longer term resistance zone on the weekly charts. Again, the daily charts, this is the focus for today. Close above that 2026 open, drill down deeper. Here's the first tag of lateral resistance. Want to see support here for heading higher. Next levels up 44 and 44, basically 92 into 45.33. That's your next major key zone of resistance. You're constructive above the median line. Again, initial support on this slope is right here. Constructive above the median line. Bullish invalidation now comes in at the July high day close. I don't want to wait to see a drop all the way down there. Anything below 41.65 nullifies this breakout. We're still in overbought condition on the 4-hour chart. We're approaching overbought condition on the daily chart. This is the highest momentum reading now that we've seen since January. Okay, and certainly suggests that we're finally seeing the tide shift here in gold. Obviously, the shift in the interest rate expectation that we looked at and talked about earlier, specifically with the September read now continuing to dwindle, that's lending further tailwind for gold. Remember, higher rates increases the opportunity cost of holding gold, which does not give you a yield or pay a dividend. And therefore, the expectation that we'll have to hold on the rate hike is just continuing to fuel this gold rally. On top of that, dollar weakness is also going to be a tailwind. So you got fundamental picture lining up pretty well with what the technicals are suggesting. Gold, very clean levels here. Watch today's close with regards to 43.19. Not much to update on oil. There is some sort of, there's been some circulating commentary that there's an agreement between Oman and Iran that does not include passage of ships for Israel or the U.S. Don't know where that stands. We haven't heard much commentary out of the administration about it, but markets still are taking this pretty much in stride. Resistance doesn't change, 79.16 to 80.75. As you get into next week, that's going to start to converge on the upper parallel of this downtrend, but still subject to any kind of headline with regards to those negotiations. So low conviction trade, but that's oil for you. Bitcoin, she's holding. She's still holding the uptrend. And just continuing to track this. There's still so much commentary about what Bitcoin is going to do from here. You still have traders calling for 56,000. You have traders calling for the low. So listen, we're staying disciplined to what the technicals are suggesting. We've been following this upslope ever since last month. It's been very clean at the median line, very clean at the 25% parallel. We clipped the lower parallel this week. So nothing changes, okay? We need to beat 67.322 to mark resumption of that multi-month uptrend. It's the breach above 72.83 that would validate a more significant potential yearly lows in place and a larger shift in reversal and trend. but we're not quite there yet. Monthly open support comes in right at 62,890 basically. You need a break below 61,244 to suggest more lows are coming into place and the broader washout. The crypto winter isn't done yet. So Bitcoin holding on to dear life here, but still holding the uptrend from last month. Okay, that's everything that's on my end. If you do have any other questions right up against the 10 o'clock hour, do let me know. Stay nimble into the close of the week. Make sure your risk is well defined. We obviously still have those headlines coming out of the Middle East that could shake things up. The focus next week will be on that CPI print on Wednesday, so make sure you're attentive to that. Remember, again, I'll be out next week. So my good friend and colleague, James Stanley, I've worked with the guy for 20 years. A little bit of a different style, but a very unique take on price action. I'm sure you'll enjoy his coverage next week, as well as Razan. I will be back the following week. So the first webinar will be back on Monday, August 17th at 8:30 Eastern for the weekly technical update. We'll give you a full hour updating all the latest reports and where we stand heading into the start of the week. And then we'll be right back here in the opening bell at 9:30, again on Monday, August 17th. So until then, guys, have an awesome week. Enjoy James Stanley. Best of luck trading, and I will see you in a week's time. God bless.